Hey, good afternoon, everyone. Welcome. Thank you all for being here. You've got the entire senior Department of State Treasurer team in addition to me today. And so we're happy to take questions about just about anything that we do. Maybe before we get into all that, a couple opening comments from me. 2025 has been a great year for the Department of State Treasurer. I've been blessed to have a lot of amazing team members, many of whom are on the line today, but 450 of whom are not. And all of them have led to a lot of successes for us this year. I led off in January sending the team an email that had two quotes in it, and those quotes have really underlined a lot of what we've done this year. The first is from Mary Chapin Carpenter. And she said, "The stars might lie, but the numbers never do." And what you'll find in probably every answer you'll get to questions is it's all about the data. And the numbers take us to where we want to go as a department. And the second was a quote from Charles Kettering, and he said, "If you've always done it that way, it's probably wrong." And so we've spent a lot of the year trying to innovate, trying to do different things so that we can deliver better solutions for the people and the taxpayers of North Carolina across everything that we do. And so those two quotes permeate a lot of what we've tried to do this year and that we've been successful doing. A handful of big highlights this year, as many of you already know, were the changes to the investment function through the Investment Modernization Act and the resulting returns that have begun to show up as a result of all of that. In a world where not a lot is bipartisan, getting that a piece of legislation through both the House and the Senate unanimously and onto the governor's desk and signed by him in June in very quick timing for such a fundamental change is really gratifying, and it's paid dividends. The second is taking over the state health plan in the midst of a financial crisis, and Tom and his team leading that plan to a path forward that is sustainable. And all that went into that, some less popular than others, but all with a goal towards making the state health plan a benefit that we all can count on into the future, has been a major effort and a big success for the team this year as well. And then the adoption of technology and changes to process, whether it was the pilot program we did in artificial intelligence with OpenAI, or the first bond tender in state history, or record receipts into unclaimed property through the data matching process in OpenAI, implementation of the cash flow loan program, the beginning of ID.me implementation in the retirement systems division, changing our wiring process, and on, including changing our domain name to nctreasurer.gov. You'll see a number of new approaches to old problems, which have delivered a lot of great results. And so we're really proud of 2025. We're looking forward to 2026 and many of the things that we'll do in that year. And then we wanted to take questions from you all about really anything that's on your mind. You can put them in the chat, and we will get to them in the order we receive them. So thank you again for being here, and we'll look forward to your questions.
Why don't you tell them for right now, if they have the question, they can unmute and go ahead and ask.
Okay. If you have, there we go. We'll start with Ray Gronberg's question about Cigna going out of network for UNC Health. We've obviously been through a bit of a public battle ourselves in this regard with Aetna and Duke, and so have firsthand experience with how these situations go. You know, the history would tell you that going out of network is not a condition that lasts very long. And so I hope that that's the case. I hope for Cigna's members and for UNC Health's fiscal solvency that they get this figured out soon. It's not directly relevant to us, of course, but it's a sign of the times in that everybody's struggling with the cost of healthcare going up and outcomes not getting better. Tom and his team have spent a lot of time trying to align incentives between the providers and our members, where if we get better outcomes at better costs for our members, then we're happy to share some of those gains with the providers. By setting up systems like that and incentives like that, you hope that you can be on the same side of the table as your providers, which allow for better long-term relationships and not these incessant threats of going out of network and dragging your members into being scared about the future of their healthcare. Anything you want to add, Tom?
No, I think you said it well.
Thanks.
Next question is AP Dillon.
Okay. So from AP Dillon, has your office seen any blowback over the new SHP formula using bands? The answer is of course. When you had a situation where everyone was being charged $25 per member per month, again, relative to the average commercial premium in the state of about $180 per member per month. And that went up to 35 in the lowest band, and then progressively more than that in higher levels of income. There's been pushback, certainly from the people at the higher end of the income distribution, who make the argument that they're getting the same health care as the people at the low end of the distribution. And while I understand that, we had a financial hole to solve. And in the end, we needed to ask people who could contribute more to contribute more. So of course we've had pushback, but I think we landed in the right place, and I think many members appreciate that at the lower end of the income distribution.
James?
And this is where I'll ask Kevin to chime in as well. What changes have you made within the investment portfolio now that you've reorganized the investment management office? I'll start and then I'll hand it to you, Kevin. I think the biggest change you'll see in the asset allocation is a decline in the amount of cash that we hold in the portfolio. At one point, we had almost $14 billion, I believe, in cash in the portfolio. That number is closer to 4 today. So deploying that cash into higher returning assets has been an enormous difference, and it's really responsible for a lot of the gains this year. Kevin, anything you want to add?
Unfortunately, I missed both the question and most of your answer.
Sorry.
Having bandwidth issues, apparently.
What changes have you made within the investment portfolio now that you've reorganized the investment management office? And my answer was principally a deployment of cash.
That's right. So on a net basis, we've deployed about $6 billion to a whole series of asset classes: equities, investment grade fixed income, some shorter duration asset-backed securities, both high grade and high yielding. And it was always sensitive to what was happening in the market at that time and our outlook. Yeah.
Excellent. Thanks so much.
Thank you.
Sorry, we had a fire alarm go off here. Sign of the times, I suppose. I know that getting a higher rate of return for the retirement system was a big point of emphasis for this new administration. What factors do you consider most important to the gains seen this year? And Kevin alluded to it, and we talked a bit about the cash. I think a couple things. So having discipline around asset allocation. We changed the asset allocation in January, and then we stuck to it as the year went on. Is really a big difference. I think the tendency in the investment business is unlike any other good. The joke is that in the investment business, when the store goes on sale, everyone runs out of it. And that's exactly the opposite of what you should do, is you should buy more when it's cheaper. And so April was that. When Liberation Day occurred and the market sold off by 15% over the course of several days, once we had satisfied ourselves that the Trump administration didn't intend to kind of blow up the entire economic order, then we rebalanced. And that discipline and that sticking to our asset allocation, I think, is responsible for a lot of the incremental gains this year.
Teresa's question.
Okay. Any insights into what is ahead for your department in 2026? There are a lot of things that we intend to accomplish in 2026 across every division, which will be, frankly, more similar to what we've already done. Better stewardship of our resources across everything we do. Adoption of technology into each of our divisions is a process that we've only just begun. We run, in many cases, software that is 20 years old or older, and all of it needs to be modernized. Our business processes need to be updated in many cases. And so you may not see a lot of this as headlines or as something that you'll obviously notice, but it will show up in results that are material over time across every one of our divisions, whether that's in state and local government and adopting technology so that we can process responses to our members and evaluate audits quicker, whether that's implementation of ID.me in the retirement system so that we can get people into their accounts much more easily, quickly, and without overtaxing the call center. You'll see this throughout everything that we do. So given that we have 7 divisions, I won't go through all of them, but to say that a data dependency and a commitment to try new approaches to old problems to get better results will pervade in 2026, just as it has in 2025.
Question, follow up to AP's question for.
Tom, maybe I'll ask you to handle this one. Similar to AP's question, with open enrollment now closed, where do the finances of the state health plan stand? Were there any surprises in terms of employees enrolling or not enrolling their kids?
Good question. So with respect to open enrollment, I think there are a couple surprises, and I wouldn't say good surprises or bad surprises, kind of how it's structured. We did see a slight uptick in folks enrolling their kids in the plan. We thought that was really good news. We did see more folks go into the plus plan, the richer benefit. And I think that's probably a little bit responsive to the economy and a few other things kind of going on where people want more security in their health plan. Because the premiums are higher, we would have anticipated fewer people would enroll in that plan. That was not the case. The other piece that was maybe a slight surprise was fewer people left the Medicare 70/30 plan to go into a Medicare Advantage plan that we'd probably anticipated. Those things relate to the plan's finances, we continue to be, following the changes by the board and the action by the General Assembly. We are not going to be in a deficit for 2026 or 2027. We still have work to do, though. By the end of 2027, we are getting close to our stabilization rate. Remember, we were projecting a $1.3 billion deficit in 2027, and now we're about $30 million above our reserve rate. So astronomical changes, but that doesn't mean work doesn't still need to be done. Our trend this year is running higher than previous years. Part of that is a function of that Aetna pays their claims a little bit differently. Part of it is some pent-up demand from other things. So there's work to be done. I would anticipate benefit changes in 27. We'll be voting on those in March. I would anticipate premium changes. Those will be voted on in August. I think both will be a lot smaller in terms of magnitude and scope than this past year. But while we are in significantly better financial footing, we're in the black in both 26 and 27. There's continued work to do just so we can continue to be in that position.
Thank you. Sure. So Sam Watts, if you're on, I'd love for you to take this one. Can you further expand on the Medicaid clawback reversal? What are ABLE accounts and what were the clawbacks?
Sure. Happy to do that. And we're very glad to be able to partner with the Medicaid program and with the General Assembly to accomplish this because it was the number one reason we had people telling us that they did not want to sign up for ABLE accounts. In short, ABLE accounts are savings accounts, much like a 529 college savings plan, but where money's invested, we do the investments here through the Treasurer's Office. We manage the ABLE program and, as a part of a partnership with 20 some other states. And for disabled people who invest in the ABLE program, they're able to set aside money above what the caps on savings you can have under the Medicaid program. Well, when the Medicaid clawbacks were in place, people were afraid to start accounts because if they were to die, their family would lose access to the money they had saved. So if a family set up an account for a child and the child did not live, then they would lose the money they had set aside for that child, not for the benefit of the rest of they wouldn't have it for the benefit of the rest of the family. And so that was we learned not required under federal law, except in certain very rare circumstances. And so we asked the General Assembly in collaboration with the Medicaid program to loosen the state restriction on that. And so now we've had an uptick in people taking advantage of ABLE accounts.
Thank you, Sam. Charles also asks, can you tell us more regarding fraud prevention and how did the department correct issues with detecting fraud? I'm going to ask you to answer that from the RSD perspective, Sam, but let me answer it from the DST perspective first. The old Willie Sutton line, when they asked him why he robbed banks, and the answer was because that's where the money was. Well, that's the Department of State Treasurer within the state of North Carolina. So we have all sorts of attempted fraud all the time and are very aware of that. And so we have a robust IT architecture to try to protect us from that. I know we've seen that in every one of our divisions, and we've got processes and, again, technology that helps us deter those fraudsters and eliminate it where we can. One of the big areas that we get these inquiries, so to speak, is in the Orbit system. And we're actively engaged in upgrading our ability to authenticate people there. And so, Sam, maybe give people a quick overview of the ID.me project.
Sure, we're happy to do that. We use a knowledge-based authentication procedure now to validate users logging onto the Orbit online self-service program for retirement, and we are migrating in the first quarter of next year to ID.me, where people would be able to set up an ID.me account and upload their driver's license, and they can validate with a photo of themselves for their log on. That's a more secure and more rapid way to validate identity, and we will protect our members even more than we do today. We did prevent numerous fraud attempts this year, people trying to spoof identity of members of the retirement systems. And we were able to save hundreds of thousands of dollars that members would have lost or could have lost if not for the efforts of our team here. And our upgrades of our technology, particularly with the ID.me project, will continue to strengthen those efforts and to make it even more secure for our members to use our online services.
Thank you. So we'll go to Ray Gronberg. Explain the $181 million reduction in general fund debt. The percentage given implies about $2 billion in debt, but at the end of the 2024 calendar year, the state had total debt of $7.9 billion. And I'll ask Denise and/or Jeff to chime in here, but let me answer the high-level question. We looked at it as a percentage of general obligation debt. The $8 billion refers to not just general obligation, but limited obligation bonds, and then Garvey debt and other forms of non-taxpayer supported indebtedness. So if you look at it just versus general obligation debt, it's well over 10%. But I'd love for Denise and/or Jeff to give a little bit more detail around the transaction itself and how it came together.
Sure, I'll jump in. Denise Canada, the director of the State and Local Government Finance Division. What Treasurer Briner said is exactly right. The total that you've quoted, maybe from the Debt Affordability Study report, I'm not sure, does include debt that is not supported by the state taxes. That's the difference between the two numbers. We're looking at it as a percentage of, as the treasurer said, the state or tax supported debt. So that would be the difference. And then as for the transaction itself, I'm very proud of our state debt team for pulling together what's probably the most complicated debt bond refunding transaction that has taken place to date in North Carolina. This transaction involved refunding some limited obligation bonds. So refunding, by that we mean refinancing, essentially at a lower rate. It also involved refunding some additional general obligation bonds and what's called a bond tender, where we are able to buy our bonds back on the general market at a price lower than face value ultimately. So between putting in some additional from state cash from prior bond issuances that was left available, you may have seen a press release about that, and from the interest rate reductions, those two combined led to the reduction in general fund debt. Thanks.
So we'll move on to Matthew Sasser from NC Insider. Are there any forthcoming partnerships from the Treasurer's Office when it comes to artificial intelligence? What did you learn in 2025 that the Treasurer's Office can take into 2026? We have a material partnership with Copilot ongoing, and so Microsoft, where we can have them inside the fence and have access to our data because of the security and privacy controls that Microsoft guarantees. And so we're doing a lot with Copilot. And then some of the individual divisions are looking at other AI solutions unique to their individual purposes. But we're not ready to talk about those because they're very nascent at the moment. We continue to try to adopt technology wherever we can find it. AI is only one of them. There's a lot of software solutions that predate AI that we're still not to a level of using. So we've got a lot of technical debt, so to speak, that we're cleaning up across all our different divisions. What do we learn? We learned that there's huge productivity increases to be had from adopting these tools. But the human element is always a challenge in getting to those. I think first and foremost, it's making sure that our team understand what we're trying to do. And that's what we're trying to do is improve the quality of their job, improve their productivity through taking the basic and mundane pieces off of their plates, rather than an existential threat, because that's what these technologies are first considered to be by many people, understandably. And so I think the productivity gains and managing the human element are the two big takeaways that we took from the OpenAI trial. We'll go on, and Tom, I'll have you fill in anything I miss here. Reactions to the governor's request for funding from the One Big Beautiful Bill's $50 billion Rural Health Fund, and thoughts about potential uses of that. So we're very interested in this topic. We obviously touch rural healthcare extensively through the state health plan. We spent a lot of time thinking about it. We, in fact, went out to DHHS and the governor's office to discuss this application, had discussions with our congressional delegation about it, offered extensive amount of input that was not taken into the application. We would have preferred a more transformative approach to actually deal with the diseconomies of scale that are endemic to rural health through use of technology, and DHHS went a different direction. The other thing I would say is that it's not intuitive to me if we are, 5.5% or more of the rural population of the country, why you wouldn't ask for 5.5% or more of the rural health money, but that was the decision that was taken by DHHS. Anything you want to add, Tom?
Yeah, I think what's important for us is everything the treasurer said. And, in most counties in North Carolina, we are, generally speaking, one of the top 3 largest employers between the state and the school systems, community colleges, and everything. So we have a duty to do better by rural health. And, despite us not being entirely thrilled with the approach taken, we are going to continue to invest in rural health because that is our job and our duty. And we want to take care of those folks in North Carolina. So we're going to continue to build out our primary care network, our behavioral health network, our OB-GYN network in those communities. And we're seeking and building active partnerships there to be truly transformative and make sure there's always healthcare in rural communities, and leveraging our position as the largest commercial employer in a lot of these areas to make sure there is access to healthcare. And we're going to continue to push for that. And we think we have a lot of carrots and incentives to offer those practices. And we're working with the 3 biggest primary care groups in North Carolina to build that as we speak.
Thanks. Okay. I'd like to hear directly from Brad about the sell-off of the $6.4 million in Israeli government bonds. This is said not to be a divestment, but at the end of the day, how does one tell the difference? It's a totally fair question. I think a couple pieces in response. One, timeline. So we received a petition from that divestment coalition at the end of October. We had sold the bonds before we received that. So it'd be hard for it to be about divestment when we'd already sold them by the time we were asked to divest. I guess a simple matter. The other piece is philosophical. We have a state law that we must obey about what factors we can and cannot consider when we make investments. And so we're going to do that. 1, and 2, all the academic research would tell you that divestment campaigns of any kind, and each side has different flavors of these things, are expensive. They cost taxpayers money. We're in the business of making our state wealthier, not less wealthy. And so we're not going to engage in that in either direction. But I think you don't have to take our word for it. The timeline speaks for itself. The other fact that I'd point to is that we own Israeli sovereign bonds in other pools, just not the retirement system. So, can you, Luciana? All right, Luciana, can you expand more on what you expect in terms of state health plan finances going forward after 2027 and what changes, including premium changes, could look like? Let me begin with a high-level comment, and then Tom, please feel free to add anything. As it comes to premiums, what we're trying to do is set premiums as a percentage of income and have them be very consistent as a percentage of income going forward. It is important for people's budgeting that they know how much of their paycheck will go to healthcare, but it is equally unrealistic to expect that on a dollar basis that they never go up. And so we've articulated that intent. We expect to live up to that intent. Everything that we know right now around the state health plan suggests that we will be able to do that into the foreseeable future to keep premiums consistent as a percentage of income rather than as a dollar number. We have made very good progress in digging out of the hole, but as Tom said earlier, and I'm sure he can elaborate, we have more work to do. We have been on a medical cost trend of almost 6% increases and a revenue trend of the state health plan of about 3% up each year. It is a basic business problem. If your expenses are going up faster than your revenues, you're going to be in trouble sooner rather than later. And so we've got to get that 6% down to the 3% is the central task. Tom, do you want to add to that?
Yeah, so I think the big buckets of things is I think about it a few different ways, right? So one of the things we're going to talk about at the board meeting this Friday, when you think about the triangle area, in imaging, which is something a lot of people get done every year. There are places right now where we are paying 2 times as much for an MRI, 2 times as much from a CT. It's relatively cost agnostic to the members. So we're going to start to build in some incentives in place for our members to go to those freestanding places that are lower cost. So a lot of the strategy is the future cost growth is going to be contingent on how successful we are at steering folks to lower cost settings of care. And that's going to take some time to bear out, right? We're not going to cure everyone's diabetes tomorrow, but we need to start working on it. We need to do a better job of start working on it. The more folks that get surgeries through Lantern, the lower future cost growth increases are going to be because we're paying less money for it. And I would tell you the state employees have been fantastic partners at helping us do that. We already have over 200 cases before the program even starts in earnest in January. So we're making tremendous progress in terms of addressing unit costs, and we're going to continue to push on those things. I think those are what we're going to do regardless of premium changes and money needed. That's the right thing to do. It's the right thing to do to help our members and help our taxpayers pay less for healthcare. So we're going to continue to push on finding those opportunities to reduce costs in the system and partner and share more of our resources and wins with the folks that really want to work with us. So the strategy is going to continue to evolve and unfold. But I think in the short term, where we're really going to be focused in the next couple of years is where can we help our members save money, and where will that help the state health plan save more money? And those aligned incentives the treasurer talked about. We have a lot of providers really eager to work with us that are a lot cheaper and higher quality than a kind of broad swath of providers. And we're going to continue to build out that structure. So I think you're going to continue to see more and more of that. And the more successful we are, the lower out-of-pocket cost members have, the lower premium increases are. Those are the right things to do. So that we're going to continue to push on those levers. What healthcare is going to look like in 2028, I think is probably as clear as what the economy is going to look like in 28, what cryptocurrency is going to look like in 2028. We know we're going down the right path, but being very, very specific about a dollar amount where we're going to be in 28 is probably not as bold as I would be.
All right, you teed up the next question, Tom. Thanks. The new option to invest in digital assets caused somewhat of a stir earlier this year. How's the Treasurer's Office approaching assets like crypto and stablecoins, and has its perspective on digital assets shifted over the course of this past year? I don't think our perspective has shifted much. These are interesting technologies, and the underlying blockchain technology is profound in what it can do to various aspects of the financial architecture out there. So we continue to be interested in them, we continue to study them, we continue to not own them directly. The act that would have allowed us to invest up to 5%, as you know, passed the House, but not the Senate. We do have an ability through synthetic means to invest in digital assets today, and we choose not to do that. We have not found their risk and return to be a compelling match for what we're trying to do in the retirement system. If we could make 6.5 or 7% consistently with no volatility, we would do that because that's the central goal we're trying to meet in that program. And a highly volatile asset like Bitcoin, as an example, doesn't really help us do that. It is, of course, down at the immediate moment. It's been up a lot too this year. That volatility profile is ultimately the challenge, in addition to the fact that it appears to be a proxy for liquidity, and we've got lots of other proxies for liquidity that we can invest with more predictability than that one. So we continue to study it. We continue to be interested in it. There are some existential threats for certain companies that come from digital assets, and so we're monitoring those. But in terms of advocating for investing a large chunk of the pension system in these assets at the immediate moment, I wouldn't hold your breath. Could Brad or Tom provide any more insight into the approach that they would have liked to see DHHS take, or suggestions they made about the Rural Health Fund application? Maybe just one quick comment, and I don't want to belabor this because ultimately the federal legislation requires the governor to sign the application, and it's his right to do what he wants to do as a result of that. I think the ultimate problem in rural healthcare is somewhat obvious, but it's also very hard, and that's that you don't have enough people. So how do you design a business model that doesn't depend as much on in-person visits, that doesn't depend as much on local populations to get to a business model that makes sense for the providers in the area? Whether that's implementation of technology or also an adoption of a centers of excellence kind of model where you send people to various regional hospitals for particular procedures in that area, that hospital becomes expert in them. There are a number of pieces of the business side of this that are really profound into solving the rural healthcare problem. That is where we leaned in. That is where we wanted to be involved. But ultimately, the governor, as is his right, decided not to do that. So, Tom, is there anything you wanted to add?
Yeah, I think the only thing I would add is something the treasurer has always articulated is the value of scale. And I think we bring a lot of scale with our commercial volume, and we can bring a more holistic North Carolina strategy to the proposal, particularly to the treasurer's point of given how big our rural population is between Medicaid, between the state health plan. We just think there was more room to do something kind of cutting edge and innovative and holistic that would leave long-term impact on the business of healthcare and letting those doctors really focus on the delivery of healthcare, not having to just manage their business as well. And that's where I think we wanted to see more focus.
If you could lower the cost structure inside these businesses through adoption of technology, particularly AI, particularly revenue cycle management, and some other technologies around lowering the average provision of cost, it allows you to serve less patients profitably. That's the essence of the rural healthcare problem, is less patients. And so that's, again, where we leaned in pretty heavily. So Ben Humphreys at NC, I joined late. What is the current state of the Helene cash flow loan program? Is there still unfulfilled need? Jeff, you want to give an update on the cash flow loan program?
Sure. I'm Jeff Poley, Director of Disaster Services. We have lent out all the money allocated through the General Assembly. It seems to have been a popular program. We got the program up and running. It does seem that there is a desire from the localities for more of the money, but of course we need the General Assembly to give us that money to then loan back out. So we hope to have that opportunity, but that's of course not up to us. We are not the legislative branch, so we do what we're told. So
it's up on the website who all the recipients of the loans, so you can see that in real time. I believe it's the full $151 million has been allocated at this point. Okay. Well, thank you, everybody. If there are any other final questions, feel free to unmute and ask. Ray, we will send you the specific link for the cash flow recipients so that you can see that. It is a wide array of size and rural versus urban throughout all the affected counties. So we're pretty proud of how that money was gotten out to so many different entities so quickly. And you'll see that in the link that we'll send you. Happy to take any other questions if folks have them off the top of their head. Otherwise, we'll thank you for your time and wish you a good December. Okay. Thank you, everybody.